Hi, in this video I'm going to look at some of the factors that influence investment decisions. So we are down here now looking at investment criteria, non-financial factors and risk and uncertainty. So what are investment criteria? So investment criteria are a set of guidelines or rules against which a decision about whether or not to proceed with an investment can be made. So before an organisation even sits down and does its investment appraisal, they might come up with a list of 5 or 10 rules maybe that if any of them aren't met, the investment will not be gone ahead with, the project won't be gone ahead with. So let's say they're thinking of opening up a new factory. They might set certain criteria about the expected rewards of the project or when it should be paid back in order for it to go ahead or not. They might say, well, you know, this project should be paid back within 2 years. If it's not paid back within 2 years, then that is a red line for us. We're not going to cross it. And these are the criteria against which we judge each investment. So some of the financial criteria that might be set. So first of all, a timescale for repayment. I just mentioned it there. Is the organisation focused on the short term? We want any investment paid back within a year, within 2 years. Or is an organisation prepared to take a bit of a risk and invest more long term if they think that those long term rewards will come in the future? But either way, businesses will set a timescale for repayment. Most businesses would prefer to be paid back sooner. Businesses will consider the minimum return on an investment. So the minimum return is maybe calculating the average rate of return or a figure for the overall project using net present value. We expect this investment or any investment to return at least 10% a year or return at least £100 million over the lifetime of the project. We could see the minimum return as a reward for risk, which is to be compared with the interest rate. So let's just say we calculate the average rate of return at 10%. Well, we'd want to consider, okay, so if this investment is going to cost us 50 million, we think it's going to get net as an annual rate of return at 10%. The alternative is to put the money in the bank and just get an interest rate. Let's just say it's 2% for argument's sake. That means the return for the organisation's risk is 8%. They could earn 2% from just putting the money in the bank. Is the organisation happy with that 8% return for risk? Because obviously any investment is a risk. It's far safer to put the money in the bank. An organisation might also set financial criteria around the accuracy of the calculations. Are we 90% happy that these calculations that we've used, these revenues that we're predicting, these costs that we're predicting are accurate? If we're not 90% sure on the calculations, then maybe we won't go ahead with the investment. All right, but we're going to consider, we're going to want to consider how accurate are these? Are these based on fact or are these based on someone's opinion? And that's a good way to evaluate investment appraisal in a question, to question where the figures have come from and what data it's based on. The non-financial criteria that a business might consider before making an investment. Well, the economic prospects. A business might only invest if they think the economy is going to do well. All right, so no investment if they believe that GDP will fall. Some businesses have different attitudes to risk. It's related to their culture. Okay, so some businesses will have an entrepreneurial culture that supports risk, or other ones will be risk averse, and that will dictate whether or not they are willing to go ahead with an investment. Businesses make social and ethical considerations. Okay, so if this investment might be considered to be damaging to a particular stakeholder, we're benefiting customers because we're building this new factory, but it's at the expense of the local community. Some businesses may consider that that's too much of a cost, and will consider all of their stakeholders before proceeding with the most profitable investment. Another important non-financial criteria will be how is each functional area affected? How are the people within our business affected by this? Will they need more training as a result of the investment? Will this have a positive or negative impact on morale? What about the brand image? How is this investment going to affect our brand image? These are all non-financial criteria that a business would want to consider before proceeding with a investment. So we need to consider risk and uncertainty as well. It's one of the points that's specified on the specification. So risk and uncertainty. So how are we going to finance the investment, and is it appropriate for the investment itself? So if we are looking at an investment that's going to return us 5% a year and we're borrowing money to do so, maybe the loan is going to cost 3% a year, suddenly that investment seems far less appealing because of the method that we're using to finance the investment. Are we going to have to sell shares, in which case we give up some decision making power within the business? So any method of financing the investment needs to be carefully considered and is a form of risk. You know, what else could be done with the money? Opportunity cost. It's a risk. We're investing in an uncertain in a project with uncertain outcomes. It's far safer to put money in the bank. So what is the opportunity cost of this investment? Is the uncertainty worth the risk we're taking? The market reaction. Anytime you make an investment, bringing out a new product, for example, you know, I'm thinking perhaps of that Samsung phone that kept on catching fire. You know, that was a huge risk. There was uncertainty in developing that project, and the risk didn't pay off. Consumers reacted badly to the fact, understandably, that the product wasn't safe. So there's a huge amount of risk and uncertainty involved in the market reaction to any investment. Unforeseen events, talking about changes perhaps in the external environment, economic changes in the economic environment, the political environment, can all make our predictions inaccurate and therefore increase the risk and uncertainty of an investment. And finally, you know, to what extent will an investment make a significant contribution to achieving our corporate objectives? Because that's what this whole unit 3.7 is about. We're looking at how we can achieve our corporate objectives. Will this investment actually help us achieve our goals? There's a risk that maybe it won't. So just finally to finish off, we want to consider the use of quantitative versus qualitative data. So quantitative data is numerical information that is used to implement investment decisions. The strengths of quantitative data is relatively easy to put financial value on costs and revenue. Short to medium term predictions for costs and revenue are more likely to be accurate than long term ones, and predictions for investments can be linked back to our financial objectives. So it's useful to use quantitative data because it's so easy to understand. You know, we can immediately see this project earns more than this one, therefore it's more valuable. So that's the strength of quantitative data. Weaknesses, well, once we get further into the future, it becomes far more difficult to forecast costs and revenues. Any interest rates, the discount factors that we're using are likely to become more inaccurate. And we can question again where the quantitative data has come from. You know, is the person who's producing this quantitative data in favour of this project and therefore maybe skewing the data? Right, it's a good way of evaluating in an essay. The qualitative data that would be used to making investment decisions based on opinions, attitudes, beliefs, intentions. So asking people what they're going to do, asking workers what they think about an investment. This is far more subjective than quantitative data, but it's also used to implement investment decisions. So what are the strengths of using qualitative data? Well, we can ask the views and opinions of stakeholders. Should we open this factory? Would you like this product? Etc. What impact would this have on our image? So it's useful because we can bring in factors that aren't considered by the numbers, and we can consider the ethical impact of the investment. However, qualitative data is difficult to collect and analyse accurately, and you can get confusing, conflicting opinions, attitudes, beliefs of different stakeholders, which might make the decision-making process far more difficult. How do you compare the positive reaction of customers to the negative reaction of the workforce? Customers want it, the workforce don't. How do you square that circle and decide whether to go ahead with the investment? Okay, so lots of things there that the business will want to consider before an investment decision is made.